Let's talk about these markets. We've seen really interesting movements, not just to the upside, but also something of a rotation. A worst is first, if you will. Since the October low, some of the most beaten up sectors have been the best performing, namely areas like real estate, other sort of bond proxies. And some are saying, like John Stoltzfus, who we're going to speak with, that's going to carry out through next year. Let's get some perspective. We've got Eric Green, portfolio manager at Authentic Asset Management. Thanks for joining me.
Always a pleasure to be here, and happy holidays, by the way, to you and to everybody, all of your viewers as well.
And to you. Now, is it going to be a happy holidays for the markets? It's certainly looking like that, and I know that you tend to err on the side of caution when it comes to these big risk-on rallies.
Yeah, well, it's to answer your question, yeah, I do think it's pretty clear sailing through year end. If we're going to have a Santa Claus rally, I think it's been a perfect setup because we had the Fed pivot that, frankly, the markets really anticipated pretty much over the course of the month. You look at the small caps and mid caps, really outperforming this pivot to the Fed to lowering rates. And when I look at the Fed meeting this week, and all of a sudden Powell is very actively talking about rate cuts. That sounds like nirvana. Is he seeing something that we're not seeing? The answer is no. The reality is that, you know, we've talked about this a lot in terms of some of the economic vulnerabilities going on in the system right now and the lagged effect of tightening. And basically what the Fed is doing right now is saying to themselves, okay, inflation is coming down a lot faster than we thought. Now, if you remember, if you go back in June, for example, they thought that inflation would be 50 basis points higher. So it's coming down a lot faster without having to destroy the labor market. And so I think that basically what they're doing is saying, you know what, given what I'm seeing and the slower growth prospects, if we don't cut rates, then we're effectively tightening in real terms. So I think that when the market looks at, and when I look at how the Fed is looking at the world right now, this is really classic risk management monetary policy.
I mean, this sounds amazing, doesn't it? That we went through unprecedented stimulus, and it looks like we're going to stick the landing. And as I mentioned, we had bank failures in March. The whole thing could have toppled over. Yeah,
we will stick the landing. The only question, of course, is what landing. And, you know, I think sometimes we get a little too much caught up in terms of soft, hard, you know, it's all very relative. The way I look at this, Amber, is am I lower than what the market is priced in? Am I lower? Am I a little more cautious in terms of what the market's expecting in terms of growth next year? And the reality is, and I'm sorry to say, I still am. And there's a lot of
where's that coming from? What's informing that?
Well, first of all, you know, we haven't, first of all, I'll be the first to admit that this year outperformed what I was expecting. Absolutely, no question. But then when you tease yourself a little bit below in terms of what's going on, you know, a lot of the factors that shaped a better outcome this year are fading. When you look at fiscal stimulus, it's not going to be the tailwind that it was next year. When you look at the savings from the pre-COVID, not pre-COVID, but in terms of the COVID era, that's not residing in the top 10% of folks. So that's not going to be a big fill up to spending. You're seeing hiring. Gross hiring is weakening pretty considerably. Jobs hard to get are moving considerably higher. The point I'm making here is that the wage gains surge is over. So we're looking for a little softening there. CapEx spending will be falling next year. So when I throw all of these things together and the ongoing liquidity drain that we're going to be seeing from the balance sheets, yes, you're going to be getting rate hikes. I'm sorry, rate cuts. Yeah. Rate cuts. That's, I think, in terms of more just sort of keeping things where they are, right? Because in real terms, if they don't cut, and I think that what we see in 2024, if I can just put on my optimistic hat just for a moment,
please. Oh,
is
dust
that
it off.
We will be looking at rate cuts. I think mid-year is an absolutely reasonable expectation. I know since the Fed meeting, folks have been trying to bring that a bit forward. Be a little bit cautious on that. But I think over the course of next year, the market's pricing in 100 basis points. The risk is that we get more because I'm a little more pessimistic on the growth front.
And we had New York Fed head Williams kind of pushed back on the idea that March was premature.
That's their job.
So that's the job. So fine. What's the market implication of what you're talking about? How do you put dollars to work if that's the view that you hold?
Well, we just talked about the Santa Claus rally. Well, how excited can I be about that when you've got 90% of the companies in the S&P over the 50-day moving average? The RSI of the S&P 500 is approaching 80%.
That's called breadth, isn't it? Are we supposed to think that's good?
But, you know, I remember Greenspan had a term in '96 called irrational exuberance. Yes. But So I think that when you look at next year, a couple things are going to materialize. One is the fact that the slower growth trajectory is going to force earnings per share estimates to fall. Right. Now, lower rates can improve valuations, but I think what you're going to see is more of a rotation in terms of as you get rate cuts taking root, you're going to go to some of the underserved sectors that have multiples around 14 to 16 as opposed to 18 to 20, which you're seeing in the larger cap stocks. But I think that what we need to do is to sort of think in terms of, well, the risk is that earnings will be lower, and the valuation multiple that you're prepared to exercise on that is also going to be squeezed a wee bit lower. So you have a guest coming on a bit later today, 5,200. I really hope he's right? Yeah. Because I own equities just like everybody else. But at the end, and we've already come up 600, right, in a matter of 6 to 8 weeks or so. It's certainly within the realm of possibility. To my mind, I think that you're going to get better entry points.
Okay, so it seems like if you are going to go shopping, it's more on the value-oriented names, sectors that benefit from rate cuts. Throughout the year, I've talked to you about being bearish on the banks, which has been the Canadian banks in particular, which has been a call that's worked. Now, recently, especially since earnings, a lot of them are starting to perk up.
Yeah, it was not a bad earnings season for the banks.
Yeah, so would you want to go short on the banks, the Canadian banks into 24? You want to carry that through, or are you closing out the position?
You know, I think that the worst is over in terms of the Canadian banks, and the reason is that rate cuts are simply good for cyclicals like banks, right? And I think that one of the important themes when you think of the financial sector is that you're going to have a disinversion of the yield curve. And I think that's a positive, and you're going to have lower rates. And so I think you've seen the point of maximum pain in a lot of areas, but the question is, you know, how much upside is there? So from a short perspective, I'm not comfortable anymore in terms of riding that short. Yeah. That's worked well for us. But at Authentic, we like to use this in terms of hedging our beta and also looking to mitigate downside risk. But from an outright alpha play, I don't think I'd want to be short going into the new year.